Nolan, good to see you. Today we are talking about a tax-smart alternative to cash. Following several rate hikes by the Fed, investors can once again earn attractive rates on cash. But after accounting for taxes, your investment might not even be keeping pace with inflation. So what are some questions a risk-averse investor should consider before buying CDs, treasuries, or money markets?
So there are always the basics that you need to think about: time horizon, risk versus reward, all the things that we normally go over. But specifically today, one of the questions risk averse investors should look at before over allocating into banking instruments is, what are the tax consequences of
Mhm.
these individual investments? I mean, if I go buy a US Treasury bond and I get interest every single year on it, how is that interest going to be taxed versus my other income? And what does that look like for me? So that's
Mhm.
really what we're going to focus on today.
Mhm. So I want to talk through some tax smart cash alternatives, specifically buffered ETFs. And as you know, people aren't feeling great about the economy right now. And some of these buffered ETFs offer principal protection.
Yeah, and a buffered ETF, or an exchange traded fund ETF, a buffered ETF is basically a way to position your money in the market, but with some downside protection. An example that we have here on the screen basically shows you an outcome period where on the left you have a little bit of a buffer before your investment starts going down versus the broad-based market, which you
Mhm.
might be linked to, going down right away. You have caps on your upside in exchange for some of that principal protection, a variety of outcome periods. So maybe you can place some money in the market and have protections for 1 year or 2 years or 3 years. There's a wide variety of these. And then, of course, you can link these assets up to a wide variety of stock market indexes as well.
Mhm. So now I do want to circle back on taxes because cash alternatives, bonds, all subject to income taxes, whereas buffered ETFs don't generate taxable interest.
Correct. And that's true of a lot of ETFs unless they give out dividends to their clients or pay out interest payments to their clients. ETFs as an investment are not taxable until you decide to sell the asset. The buffered ETFs in particular, because they are linked up to a stock market index and are not designed for income, they're really just kind of designed for slightly preserved growth. These are a little bit more tax efficient than some CDs and treasuries, especially if your adjusted gross income is into like the long-term gains rate.
Mhm. Nolan, thanks so much for taking the time to break this down because this is not what it seems on the surface. I'm glad that we had the time to talk through these numbers. If somebody wants to talk through, the tax implications of their investments with you, what's the best way to reach you?
Sure. So they can call us at 616-301-2581 or go to cornerstone-rp.com and fill out the contact us box. And we do a variety of tax planning along these lines, but specifically just how to reduce the taxes on assets like
Yeah,
this.
really important. All right, Nolan, thank you.
Thanks, Erin.